So question number 20. Should the stamp duty paid on acquisition of the land on business combination should be capitalized to the asset or should be treated as an acquisition cost and should be transferred to the P&L? P&L, because you say that if it is not a business combination, the stamp duty paid on land should have been capitalized. This is what your Ind AS 16 says, because the direct acquisition cost. So Ind AS says all acquisition cost should be charged to be the P&L account, should not be part of the consideration. The acquirer shall account this as an expense in the P&L, and if it is related to the debt or equity instrument, it should be as per 109. So if it is a debt instrument and you have incurred the transaction cost, you take it as per 109, whatever it is done. So the stamp duty is incurred to acquire the ownership rights in order to complete the process of transfer assets, and it is not part of the consideration paid to gain the control over the business, because did you pay the stamp duty to whom? You paid it to the authorities, not to the owners. When you talk about purchase consideration, it is paid to the owners to get their assets. So it is totally different thing. It is nothing to do with the owners. You are never paid to the owners. See, in every purchase consideration, you see that owner had a liability. You took over it. You offered something to the owner. You had already purchased. You are the owner. Everything directed to the owner. But here, stamp duty you pay to the third party, and it's not going to increase the fair value. So you cannot capitalize it. It should be recognized as an expense in the P&L account. So if it is you directly paid, you account it directly. If it is already included in the purchase consideration, you reduce it and account it as an expense in the P&L. Similarly, ABC acquired a PQR. Assets were acquired, including one intangible asset, wireless spectrum license. They have to make additional one-time payment. Whether such additional payment is an acquisition related cost? Yes. It says that acquisition related costs are not part of the consideration. You have to account it as an expense. And the payment to the regulator is acquisition related cost, which is not part of the consideration, because again you pay to the telecom authority. You have to measure, intangible assets are required to be measured at a fair value, and this license cost is not going to increase the benefit. It's not going to increase the capacity to increase the fair value. Followed, no? See, it goes like this, students. One training, say for example this class, will it increase your capacity to earn cash? Yeah, it will increase your capacity to earn cash. For this, you have paid to come to the class, you have paid one rickshaw charges. Will the rickshaw charges increase your capacity to earn cash? Rickshaw charges will enable to come you here, sit here. But inherently, if you have to gain, or say for example GST is paid on this, that is not going to help you, no. So your payment for one particular thing is going to increase the inherent capacity, but other thing it will help you, but it will not increase the inherent capacity. That's the transaction cost here. So they say that you have to expense it out, you cannot capitalize. But if it is PP, Ind AS 16 you are talking, yes, you capitalize it, because there I recognize individual asset there. Here I am looking the balance sheet as a whole. Same, no. In the asset acquisition, you would have added it to the cost, because this is the direct cost without which you cannot use the asset, no. But in business combination, we say that this is not anything paid to the business owners. So if you tell me capitalize to considering what? You cannot allocate to any asset there, because we have calculate the fair value. See, standard says you debit the asset at its fair value. No, I cannot add it to the fair value, because 113 also says that only transportation cost should be added, not the transaction cost. In your case, no, I missed that. Rickshaw charges can be added to the fair value. But if any toll fees you have paid, that should not be added. Transaction cost will never part of the fair value. In 113 we will discuss why, what the logic and all. Accordingly, license fee should be treated as an expense. Two possible question. Yes, indemnification asset. Yes, the indemnification asset is not related now. We are done with the purchase consideration related theory and theoretical questions. See, what we started with the goodwill calculation, which is step number 4. in goodwill calculation, there were 4 sub requirements. One is purchase consideration. I'll give you the final format at the end, covering everything. Second is NCI. Third is fair value of net assets, and fair value of the previously held equity, fair value of the net assets. So we will, after purchase consideration, in purchase consideration, so many sub points were there. We have understood what should be included, what should be excluded. Now we will go to the second leg of purchase consideration called fair value of previously held equity. It's called step acquisition. Now we already discussed it. Previously we were holding 30%. Yes, we started significant influence from now onwards. Before that there was nothing. In 2023, I will take over 40%. With this I get a control, I am holding 70%. Standard says it should be, previous stake should be remeasured. Why? Because previously, which method of accounting you are following? 28. Now, is it your associate anymore? No. So you have to take out your associate from the balance sheet. Because in your CFS today, investment is appearing. Investment is appearing at which value? Cost plus share of profit, share of profit, share of profit, that value it is appearing. Today, it is in your CFS, it is no more associate. What you will do? You de-recognize that. When you de-recognize, book value of the CFS value goes, which is as per Ind AS 28. What comes to you? Net assets of the subsidiary, 100% is going to come. Followed, no? That's why, and okay, this particular equation now you don't go, I will explain you 110. The standard says you have to remeasure, and have we done that? For example, land, same time back, 100 crore was the book value, 400 crore was the fair value, the difference we took to the P&L, something like this we have to do it here also. But when it was an associate, have we taken our share of OCI? Yes. So if we de-recognize associate, should we do recycling of OCI items? We have to do that, no? Okay. So book value of the previously held equity, no influence or joint control, influence or joint control. If you have got no influence or joint control, you would have accounted as per Ind AS 27. No, it's not no influence or joint control. Then 109 comes into picture. I have to change this slide. I'll change it. If you don't have any influence or a joint control, 109 FETPL or FVOCI. Or I should say, instead of influence or no influence, I can say something like this. This is correct. SFS, CFS. Agreed? Book value of the previously held equity. In SFS, I will have cost or option. Here I will have equity method. The acquirer shall remeasure previously held equity on the acquisition date fair value. Recognize P&L in P&L or OCI. Why OCI? Because if you are previously holding it at FVOCI, you have to recognize in OCI. If you are previously treating it as a FETPL, recognize in P&L. Then do the recycling. That means if you must have taken some share of OCI of the associate, remeasurement, revaluation, so you have to treat it as if you have directly disposed it of. Say for example, P Limited has got a significant influence with 30%, and they were following equity method of accounting, where in CFS. Equity method of accounting is going to follow it in CFS. Now, it will recognize its share of OCI as below, 30% of 50, 30% of 100. That means, not 30%, for its 30%, 50 its share. Now, when P Limited acquires 40% stake, whatever accumulated balance of this 50 and 100 is there, no? It is going to get no recycling, because revaluation surplus is not subject to recycling. Forex reserve is subject to recycling. It will go to P&L. We'll solve the problem. This example is from one problem. We'll solve that. Like P Limited acquired 30% stake for 2 lakhs. Book value of the investment in associate as on 23 is 10 lakhs. why it is not subject to recycling? Why it is not recycling? See, revaluation surplus is not related to your business, no. It is your PP. What was your intention? No, no, okay. I can say something like this. See, you acquire because your assets, whatever gains you get, no. See, if you I can say something like this. Your question is why it is not recycling. Okay, I can tell something like this. You see this logic. You see, when you acquire an asset, you have got a valuation, subsequent measurement. Which all measurements values are there? You have got cost model, revaluation model. If you follow a cost model, what would have happened? You will measure always at a cost. On one day, you are going to sell this. You will have a P&L. What you will do? Say for example, gain is there. What you will do? Take to P&L. No, you didn't want that. Okay? That's why you opted for a revaluation model. Now, in revaluation model, what happened? No, you get that accumulated, what is that called? Increase accumulated. You always accumulate in OCI. And the day you sell it, if you want to transfer it to P&L, I will tell you, no, keep original in cost only. If you ultimately you want to move it to P&L, keep it at cost only. No, why you want to revalue, and then you want to move to cost? Why you want to inflate your balance sheet with the revalued amount? And one fine day, all realized profits you want to transfer. If your really intention, keep your balance sheet low with the cost all years, and final profit you transfer to the P&L account. It's not realized. You will realize only at the end. And at that time, you should transfer directly to the revaluation surplus through retained earnings. Now, you see here, P Limited acquired 30% stake for 2 lakh. The book value of the investment is 10 lakhs. How did it increase? Because of the share of profit. In 2023, P acquired additional 40% stake for 60 lakhs. On this date, the net assets is 80, previous stake is 40. That means 2 is your cost, 10 is book value as per equity method, and that its market value is 40 lakhs. Understood? Now, how do you calculate the goodwill? Purchase consideration. How much you paid for 40% stake? 60. How much is the fair value of the previously held equity? 40. And NCI is, say for example, 80 into 30%. Now we will not bother about the NCI valuation. But the point here is, when you add these three, it should be 100% stake for the equity. And fair value of the net asset is 80, so goodwill is 44. Now, previously held equity, you made a gain. How much? Its book value is 10. What goes out is 10. And what you considered for your goodwill valuation was 40. So, 30 is your gain. So, the journal entry will be net assets 80, goodwill 44, cash 60, NCI 24. And if you see here, no, it's the same thing. Cash 60, NCI 24. See, now comes the difference. What goes out is your book value, 10. But what did you consider in your calculation? 40. Because of this, the goodwill has increased. That is why you have to recognize this gain to P&L account 30. So, these two things together will form 40. Have you understood this? Because next question institute will ask you, please calculate the gain on step acquisition. Have you understood this? Now, if there is a OCI item, you would have passed one more entry there. These two entries you would have passed if OCI items were there. Not there, leave it. But ultimately, in every single question, whenever step acquisition happens, see what goes out, that 30% stake is your investment in associate at the book value as per Ind AS 28. But what is considered for your goodwill calculation is the fair value, because that's what you are leaving, no? What you are giving up, 30% stake you are giving up in return for 100% assets. That's why the difference between these two is the P&L. So these two things together will be this 40. See, ultimately, again I am telling you, I told you on day one of our what is that called class, we are in darkness, accounting entry is our guide. All the calculations, whatever we are doing in our entire FR is governed by the journal entry. That plus and minus comes because of credit or debit we are giving for that particular ledger. Show me one calculation where it is not there, where I do plus and minus. Other things you forget, that pre-combination, post-combination, it is an equation. But everywhere you see the journal entry is there behind it. Are you clear? Step acquisition is clear? Sorry? Yeah. Then what if you are accounting it as per 109? What goes out is as per 109 only, but I will recognize the fair value and take the difference to P&L. I will tell you. So your doubt is, what if it is 109? It is not associated. It doesn't matter, same treatment. If it is 109, already it is appearing, say instead of 30%, you would have invested 10% stake. And you would have accounted this book value as per your 109. Today's day, its fair value is 40. If it is OCI is there, you do the recycling. Recycling is always whether you treat it as an associate, whether you treat it as 109, whether it is a joint venture. If there is any item of OCI related to this investment, and tomorrow the moment you credit this investment, that it is no more required, because in consolidation investment will go off, all that OCI items will be subject to recycling depending upon the rules. Followed, no? Yes. Yes, so we'll move on to the question number 1. RS Limited holds 30% stake in PQ Limited. So step acquisition part you have understood, no? First of all, theory. Step acquisition is whenever you get the control, you de-recognize the previous one and at a fair value, and difference you take to P&L account. RS holds 30% stake in PQ. This investment is accounted as investment in associate as per Ind AS 28, where in CFS. And the carrying value of the such investment is 100 lakhs. How? We understood Ind AS 28. They purchased remaining 70% stake at 700 lakhs. So today the book value as per Ind AS 28 is this. We want the fair value. If question is very silent, what we can do? 700 divided by 70% into 30%. We could have done that. Let us see. The fair value of the previously held equity is 300. So if you would have done our method, how much you would have got? 700 divided by 0.7 thousand, same, into 30%, 300. On the date of acquisition, the value of identifiable assets are 800. So how this business combination should be accounted? Okay, first we will calculate a small purchase consideration. What is your purchase consideration? See, I will go with this manner. I will always deduct the fair value of net assets at the end. If you want, you could have done ulta format. Plus, is there any fair value of previous equity? Yes, because see, this represents 70%, this represents, you are actually foregoing, no, to get that 100% net assets. You are giving 70% cash, 30% you will say forgo, I don't want this associate anymore. Are you not telling at CFS level, so I don't want this associate anymore? Because 100% investment has to be eliminated. How much? 300, total 1000, less FVNA, fair value of net assets, which is 100%, which is 800. So you have got 200 as a goodwill. Now, what is the difference between the book value of 100 and the fair value of 300? What should I do? What should I do? The difference of rupees 200, which is book value of equity rupees 300, rupees 100, and its fair value of rupees 300 is recognized in P and L. This is considered as a sale of associate. Whether sale of associate, sale of joint venture, or sale of subsidiary, I have to recognize the differences in P and L. Can you pass the journal entries? They asked me how to account, no? What accounting entry I will be passing for this purchase acquisition? I am going to prepare the consolidated balance sheet for the first time now. Previously I was doing, it was called economic balance sheet. Why? There was only associate with me. Today I am going to consolidate with my subsidiary. So can you tell me the journal entries? Look at your working notes. Fair value of net assets. How much? 800. Then goodwill 200. To cash. Somebody will say investment. Why? It doesn't matter. Because investment to cash you must have already passed in SFS. Now it's getting consolidated, means investment get eliminated or cash get eliminated. How much? 700. To not fair value, investment in associate. Because fair value for our calculation purpose. How much? 100. 100 to P and L. Because what, see, any asset from the balance sheet goes out at book value only, no? It comes in, we have to see at what value. For this you have to recognize initial measurement. None of the standard tells it will goes out at what value. Always it will goes out at a book value. Followed, no? But it comes in, be careful. PP says cost, PP says if it is an exchange then fair value, Ind AS 109 says fair value, business combination says fair value, investment in whatever. You have to look into each of the standard, what does it says. To P and L, 200. Have you understood this? Yes, we are going to discontinue because in this consolidation, discontinuation also automatically happens. On one side, I discontinue equity, associate, and recognize subsidiary. Remaining, sir, that there is no NCA. If NCA was there, I would have said 2 NCA, 10%. Now tell me, is there any OCI items which we are recognized? Is there any OCI items of associate? See, today your whatever 2 lakh has become 10 lakh after recognizing gain of share. But it may be OCI also maybe would have been there. Is there OCI? No. So leave it. Otherwise one more entry would have come. It is 700 is paid for the 70% stake. Remaining because 30% it was already your associate. No. You will have going forward, that's why for getting 100% net assets, you paid 100% consideration. So your purchase consideration is this. For getting 100%, if you would have acquired only 80%, 10% would have been your NCA. But NCA is not your purchase consideration. Your purchase consideration is your cash what you have paid now plus what you would have foregone. What you foregone? Investment in associate you foregone. At the same time, you cannot sell. No, it's my investment in associate also, subsidiary also. Impossible. So if you have to get one, you have to sacrifice another thing. That's what the nature of rule of the nature. So you forgo investment in associate. It is also treated as like a purchase consideration. But what you forgo is not 100. What you forgo is 300 fair value, not the book value. Book value only for accounting purpose it goes. 1000 is the total purchase consideration, if you ask me. Clear? Perfect. On 1st April, company A acquired 5% equity. Beautiful. Dhanashree, your question. On 1st April, company A acquired 5% of the equity shares of the company B for 1 lakh. Now, how do you account this investment? At FVOCI under 109. Perfect. It's not an associate now. Now, 31st March, A carries its investment at fair value only. And how much unrealized gain was there? 5,000 was there. So it is 1,05,000, which was presented as a separate component of equity. What did you pass? What accounting entry you passed at the end of the year? Investment account debit how much? To FVOCI reserve. Now, on 1st of April, A obtains control by taking remaining 95%. Now, when you take over 95%, you must have paid consideration. How much consideration you paid? 20 lakhs. How much for 95% stake? You paid 20 lakh consideration for 95% and 5% you forgone your own fair value. Is it required to be restated? Not required, because already it is restated. No, on 31st March only it is restated. Sorry, yeah, not there. Okay, it's maybe it is my example. You can add it. I have maybe for your clarity sake. I think both the values are not there. No, this I must have given for not required for one journal entry to for you to understand better. Okay, solution is very small. Okay, it is a theory. For your understanding, see now what happened. You passed one accounting entry, equity investment to bank on 1st April. Then on 31st March, you passed one more entry, equity shares to equity OCI reserve. Now your balance sheet appeared like this. On 1st, okay, this is the same example. You sold that 1,05,000. That means you de-recognized it. Investment is no more. But your reserve will be there. No. So this is the concept of OCI reserve to retained earnings. You have to pass one more accounting entry. Okay. So if this was investment in debenture, it would have transferred to the P&L account. Yes, write the solution. On acquisition, at acquisition date. It's a small question, not highly probable in the exam. A limited shall recognize gain of rupees 5,000 in OCI directly in equity. Have you understood the language here? What I am trying to tell, on the date of acquisition, since you are going to de-recognize the investment, one profit is already sitting there, 5,000 rupees in OCI. You transfer directly to equity, don't transfer to P&L account, as not subject recycle. Because it's not a subject matter of recycling. If it was debenture, you would have transferred to the P&L account. No need to remeasure investment at fair value. Why? Because already it is at a fair value. If this investment was shown at cost, then you should have, or some other value, you should have remeasured like 10 and 300, like the previous question, 100 and 300. But here book value and fair value is one and the same. The fair value of 5% investment plus consideration for 95% stake is total purchase consideration. See, whatever you account it, that's what, that two things now I gave for you to explain with some understanding. Otherwise, if you look at the study material question, this is the solution. That's it, a small solution. It says that don't recycle it, you don't need to remeasure. Whatever 1,05,000 you paid plus whatever you 90% you are going to pay, you are going to include in the purchase accounting. Since they didn't ask you journal entry, we can clear, I can show you my identified assets 18 lakhs. They didn't ask you because they didn't give you all these two values. Goodwill will be 3,05,000 balancing figure. Investment in B 95%, investment in B 5% is 1,05,000. If this was at cost, you would have restated it and differentially you would have taken to P&L account or OCI. Where do you take? You will take to OCI. Why? Because originally it is shown at OCI there. Since already one equity reserve is there, you will debit that OCI reserve, credit to the retained earnings. In the previous question, we didn't do this because there was nothing like that. In this question, we are doing it because it is there, available there. Clear, no? Yes, friends.